Until now, you've learned the theoretical foundations of trading. In this chapter, we'll start covering the practical aspects of trading. I'll introduce you to the different types of analysis, and you'll learn to analyze charts, which represents the market's movements. In order to decide where to invest and how much, you must understand the market and try to figure out the direction it will take in the future. There are two basic types of market analysis. Fundamental analysis. This type of analysis tries to predict future market movements according to a country's economic news. Technical analysis. This method analyzes current market movements in comparison to past market movements. In other words, it tries to predict future trends using past movements with the help of indicators provided by your trading platform. Fundamental analysis evaluates the economic position of countries and the ways in which economic news affects the value of their currencies and equities, or the value of the goods exported by those countries. The economic news published by a country's economists has a great deal of influence over market movements. Since the USA is the largest economy in the world, it's very important to follow it. Fundamental analysis is based on macroeconomic data that is provided for that country or currency, where each country or economic bloc, i.e. Eurozone, releases a number of particularly significant and important statistics every month. These announcements often have an effect on the currency's strength. The following are a number of particularly important types of news announcements which have a particularly strong influence and usually cause very strong fluctuations in currency markets. Gross domestic product, retail sales, employment and unemployment rates, interest rate decisions, minutes from the most recent interest rate meetings, speeches made by influential figures in the market, IFO business climate surveys, PMI, Purchase Managers Index, CPI, Consumer Price Index, ZEW, Sentiment Index, relevant only in Europe. Market announcements are indicators of an economy's performance. Experienced traders know how to incorporate these announcements into their strategy. It's important to note that before an announcement is made public, forecasts for that announcement are made by experts. In many cases, the value of the underlying asset reflects the forecast, but when the actual announcement differs from the forecast, the market can become much more volatile and interesting. The following is an example which illustrates the effect such an announcement can have on the market. On April 27, 2011, an announcement was made regarding a decision taken for the interest rate in the USA. The forecast predicted a reduction of 0.25%, but in reality, the interest rate remained the same. This resulted in support for the US dollar, as can be seen with the asset's rise in value on the chart. Technical analysis is the study and investigation of the market's behavior using charts. Trading systems enable traders to analyze the market using various types of charts. Chart analysis requires the development of visual skills. To develop these skills, let's first learn about the three most common types of graphs. A line chart is the most simple and basic of the three types of charts. It is created by connecting various price units over a given time period. Each point only represents the closing price. The line connecting all the points creates a chart that helps to identify trading trends as well as support and resistance levels. Technical analysis usually requires more specific information than that provided by a line chart, so this chart is less appropriate for in-depth analysis. A bar chart includes lines that present different price levels over a given time frame distributed on a graphical diagram. These lines denote the following information. High price. This is the high point of the bar, representing the maximum bullish power for that bar. Opening price. Displayed to the left of the bar's body, representing the price when the bar opened. A bar's opening price is usually identical to the closing price of the preceding bar. Closing price reveals the results of the fight between the bulls and the bears over the course of that bar. The closer the closing price is to the high price, the stronger the bull's victory over the bears over the course of that bar. Low price. The low point of the bar, representing the strongest point the bears reached over the course of that bar. The distance between a bar's high and low points signifies the intensity of the battle between the bulls and the bears. A short bar indicates a calm, quiet market, whereas a long bar signifies a volatile, stormy market. The Japanese candlesticks chart is similar to the bar chart in that it also represents the closing, opening, high and low points for that bar, but using a different display which helps identify various trading patterns. The difference between the charts is that in the Japanese candlesticks chart, the closing and opening prices are enclosed in a rectangle. The use of different colors illustrates the increase or decrease in price over the course of the bar. This is the most common type of chart. Let's illustrate the use of Japanese candlesticks on a 1-hour time frame. This candlestick opened at 12 o'clock and closed at 1 p.m. If the market falls, the candlestick body begins to form in a downwards motion. If the market changes direction and begins to rise, what was previously the candlestick's body becomes a thin wick, also known as a shadow. If the rise continues beyond the opening price, the candlestick's body begins to form in the opposite direction. If the price reaches a peak and then begins falling again, a shadow is created in the upper part of the candlestick. The finished candlestick reflects the opening price, high price, low price, and closing price for that 1-hour time frame. If the candlestick closes at a lower price than the opening price, it's considered a bearish candlestick, while if it's closed at a higher price than the opening price, it's called a bullish candlestick. The combination of many candlesticks creates a complete chart. Over the years, economists have tried to characterize and find patterns in market movements in order to try and predict the market's future movements. Believe it or not, there are some who managed to develop theories that have been used for over 100 years. One of those economists was Charles Dow, who created the Dow Jones Index in 1882 and is considered the father of technical analysis. The books that he authored in the 19th century are considered to this day to be the foundations of technical analysis. 6 rules form the foundation of Dow's theory and are no less relevant today than they were in his day. The following are Dow's 6 rules with explanations immediately to follow. The price movement reflects the asset's economic data. The market movement is comprised of 3 main series of trends. The major trend is characterized by 3 transition phases. The leading indices must be coordinated by uptrend or downtrend in order to confirm a trend. The trading volume must confirm the direction of the trend. Until proven otherwise, it should be assumed that the trend will continue its original direction. The market movement is made up of 3 main series of trends. Major trend, all the trends that appear in the weekly, monthly, and yearly time frames. The major trend is a trend that has been going on for several months and may continue for 5 years or more. Secondary trend, all the trends that appear in the daily time frames. A secondary trend will usually continue for about 2 weeks and may continue for up to half a year. Minor trends, all trends appearing in the intraday time frames, from 1 minute to several seconds. Minor trends can last for at least a day and may last from up to a month. Trends are characterized by 3 transitional phases. The accumulation phase, the first phase of a trend, where only the most experienced and professional traders enter the market. For example, if the market was in a downtrend, this is the point where the experienced traders notice that the market data is falling and therefore begin to sell. The public participation phase represents the second and longest phase where the experienced traders enter, followed by the less experienced traders. This is also the phase where the trend gains the most strength. The distribution phase, the stage where the professionals who began buying in the first phase realize that the trend is about to reverse and realize their gains. They are followed by other traders who close their trades, thus reversing the trend. In this lesson, you've learned about technical and fundamental analysis methods and have learned the basics of technical analysis using charts. You've learned about the different types of charts and have learned the 6 rules of Charles Dow, the founder of the Dow Jones Index. In the following lessons, you'll learn how to read the charts and how to trade.